Richard, I've watched more men destroy themselves averaging down than any other single mistake. When a position goes against you, the market is already telling you something. Adding to it is just arguing with the tape.
I understand the impulse, Jesse. The composite man counts on that exact weakness. In accumulation, he absorbs the weak holders who keep averaging down on the way into the range. But there is a distinction. If the larger structure shows absorption and the volume is supporting the bid, adding selectively can be part of building a position. Blind averaging is suicide. Strategic adding after confirmation is different.
Strategic adding only works if you already know the trend has turned. Most men call it strategic when they're just hoping. I learned the hard way. Every time I averaged a loser, I paid for it in blood. Cut it. Move on. 4 open positions at most, and none of them averaging against the current.
On the number of positions, I largely agree. Concentration of force is more effective than scattering capital. The market rewards those who wait for clear cause before committing size. Where we may differ is the absolute prohibition. In a well-defined accumulation range, with volume drying on the declines and expanding on the lifts, a professional can scale in with defined risk. Outside of that structure, you and I are saying the same thing. Do not throw good money after bad.
Fair enough. Structure first, then size. But the rule remains. Never average a loser that is already moving against the trend.
Agreed. Now, the second point you emphasize so heavily, cutting losses with room rather than ego.
Yes, most men set stops where they hope the market will not go, not where the market actually proves them wrong. I place the stop beyond the nearest logical pivot, a few cents off the round number, so the stops do not get hunted in a single print. Give the trade oxygen. Too tight, and you are just donating to the floor traders.
That is sound tape reading. Effort versus result tells the same story. If the market drives through a support level on expanding volume and closes poorly, the effort has overcome the previous cause. The stop should already be resting just beyond that level. Tight, arbitrary stops ignore the natural breathing of supply and demand. I prefer the stop to sit where the premise of the trade is invalidated by the action of the composite man, not by a fixed dollar amount chosen in advance.
Exactly. The market does not care about your comfort. It cares about where the real buying or selling is exhausted.
On risk itself, you insist a man must know his maximum pain before he enters.
Before the order is even written. If a $50,000 account cannot stomach an $8,500 loss without the trader losing sleep and judgment, then the size is already wrong. Watching the P&L tick by tick is a form of self-torture that destroys execution. Know the number cold, accept it, and then forget it until the stop or the objective is hit.
I approach it through the lens of the campaign. The total risk across the entire position should be a fraction of the potential cause that has been built in the range. If the accumulation has created a measured move of, say, 20 points, the risk on the entry should be a small percentage of that expected effect. The dollar amount is secondary to the relationship between risk and the potential reward the structure implies. But yes, the risk must be defined and accepted before capital is committed. Emotional discovery of risk after entry is fatal.
We are close. I simply demand the man feel the dollar risk in his gut first, because most men overestimate their tolerance until the paper starts bleeding.
Size then. You say size is earned, never entitled.
Precisely. I could lose $50,000 in a single name and recover it before the close, because my edge and my experience justified the size. A man still proving himself cannot claim the same privilege. Confidence without a track record of consistency is just leverage on hope. Size up only after the method has proven itself under fire.
The Wyckoff approach reaches the same conclusion through different language. Position size should expand only after the market has confirmed the operator's analysis through successive successful campaigns. Early in the learning of a method, size must remain small so that the student can observe without financial pressure distorting perception. Once the reading of accumulation, markup, distribution, and markdown becomes reliable, larger size becomes the natural expression of that skill. Size follows demonstrated mastery of the composite man's intentions.
Good. Then we both reject the idea that bigger size is a right rather than a privilege earned by results.
Now the mental trap after the close, the voice that says you should have sized larger on the winner.
That voice has ruined more next-day trades than any chart pattern. It is pure hindsight poison. It breeds FOMO and turns a disciplined man into a gambler the following session. I trained myself to ignore it completely. The trade that is over is over. The only question that matters is the one in front of you right now.
Hindsight bias is the enemy of objective observation. The composite man leaves his footprint in the volume and the price structure. After the fact, it is easy to see where more size would have been comfortable. The professional studies the completed campaign for the lessons of cause and effect, then discards the emotional residue. Dwelling on the size that should have been clouds the next reading of supply and demand. We agree the bias must be killed daily.
On the days when the market is weak and the VIX is elevated, most men still feel compelled to trade. That compulsion is expensive.
The market is not always offering an actionable campaign. When the larger trend is under pressure and overnight inventory is being liquidated into support, the wise operator often stands aside. Liquidity is thinner, spreads are wider, and stops must be placed accordingly. A low-volume name requires more room. Forcing a trade in that environment is usually the mark of impatience rather than opportunity.
I used to go fishing on those days. Literally. The big money is made in the sitting, not in the constant motion. If the tape is not speaking clearly, there is nothing to do.
The phases themselves teach the same patience. In a trading range, the proper action is often observation until the spring or the upthrust resolves the balance. Outside of a clear markup or markdown, capital is best preserved by waiting. We are aligned, sit more than you trade, and match the stop to the character of the market you are in.
Finally, the rule that still cuts deepest. Never let a winner turn into a loser.
Protecting the open profit is the practical expression of respecting the change in the character of the move. When volume begins to show absorption at higher levels or effort fails to produce further result, the markup is aging. Trailing the stop to lock in the bulk of the gain is simply following the evidence. The composite man distributes into strength. The trader who refuses to protect profits becomes the liquidity for that distribution.
I learned to move the stop once the trade was clearly in my favor. Not to the entry, that is still hope, but to a level that keeps the majority of the profit while still giving the position room to work. The pain of watching a large winner evaporate is worse than most initial losses. It trains the mind to become reckless the next time. Protect what the market has given you.
On this we have no disagreement. The final act of a successful campaign is the intelligent exit that converts paper profit into realized capital. Everything that precedes it is preparation for that moment.
So we end where we began, Richard. Capital is the only thing that keeps a man in the game long enough to master the rest. These rules are not suggestions. They are the difference between lasting and becoming another cautionary tale.
Precisely. The market will always offer another opportunity. It will not offer another account once the first one is gone.